Hi, everybody, and welcome back to Chapter 22. And here we're going to look at performance measurements and responsibility accounting. In this chapter, we'll look at transfer pricing and look at how we might allocate joint costs across products in Appendix 22 Alpha here. We'll look at analyzing investment centers from the standpoint of return on investment and residual income. And we'll look at profit margin, investment turnover, and balance scorecard in analyzing these investment centers. And then we'll compute the number of days in the cash conversion cycle. And lastly, procedurally, we're going to prepare responsibility accounting reports using controllable costs, of course, and allocate indirect expenses to departments, preparing departmental income statements and contribution reports. And the key message there is only hold people responsible for what they can control. All right, let's see what we've got. We're going to prepare a responsibility accounting report using controllable costs. And so here, large companies are easier to manage if we divide them into smaller units, which we call divisions, maybe business segments or departments. In decentralized organizations, decisions are made by unit managers, and our top management then can evaluate the performance of the unit managers. And here's our three kinds of situations. We have a cost center, a profit center, and an investment center. And the cost center is they are evaluated on their success in controlling costs, shockingly. And profit centers are evaluated on their success in generating income. And lastly, we have investment centers, which are evaluated by how well the managers can utilize assets in generating income. So here are controllable versus uncontrollable costs. The controllable costs are those that a manager can determine or influence. And for example, the supplies they use in a manager's department. Uncontrollable costs are not within the manager's control. Their own salaries, for example, maybe even negotiating the rent in the manager's space. All right, so if we look at responsibility accounting, we have several levels of management, and this is the classic organization chart. We start with the board of directors. They elect a president who appoints our executive vice presidents, in this case for Europe, Asia, and the United States. So under the USA, we have a plant manager that's responsible for the Western factory. And under that manager, we have a beverage department and a food department and a service department. And then there's a manager of the Eastern factory, which doesn't appear to have these same reporting levels. Okay, so now here's responsibility accounting performance reports. So at the top side level, we have our salaries, depreciation, office costs, total Western factories numbers, and the Eastern factories numbers in total, and we have totals for the entire USA operation. Now, here, under this $2,800 $2,800 looks to be over budget by $2,800. I always use a bracket convention. Why I hesitated is that I usually bracket convention where brackets are bad and unbracketed is good. And in this case, though, under budget is bracketed and over budget is unbracketed. Any event, you can see that this $2,800, which is the controllable costs by this plant manager in the Western factory, that slides up here to a summary item here on the executive vice president's report. And then same thing here with our this subordinate manager of the beverage department has a $300 total unfavorable variance, which shows on the plant manager's Western factory in total. But it's broken down here for the manager of the beverage department to find out where the problem is. The problem is pretty obviously here with direct materials. Direct labor was pretty good, utilities was pretty good, but direct materials drove the entire equation south, unfavorable, $300. All right, so we can see that we've broken this down into its pieces. All right, so now, how do we allocate indirect expenses to departments? Direct expenses are costs that we can trace directly to a department because they're incurred for that department's sole benefit. Pretty easy there. Indirect expenses are costs that are incurred for the joint benefit of multiple departments, and they can't be traced back to a single department. They need to be allocated. All right, so let's look at that. If we're allocating indirect expense, then our indirect and service department expenses are allocated to the departments that benefit from that. So here, if I'm allocating supervisor salaries, maybe I allocate it based on the number of employees in that department. Rent and utilities, maybe I use square footage of the space that they occupy. Advertising, maybe as a percentage of the total sales, and maybe insurance, the value of the insured assets. So let's see how we put that to work. Here we're talking about the allocated cost, that's the total cost to allocate, times the percentage of the allocation base used. Here we have 4 allocation bases. So the service department costs are shared by 2 or more departments, and the service departments include personnel, payroll, and purchasing. Very common. So if we look at that, we have our personnel and payroll here and purchasing here. So how are we going to do that? Well, here, a retail store pays an outside company to clean. Pretty normal. And the total cost of the cleaning service is $800 per month. So management's then going to allocate that cost of cleaning across that store's 3 departments based on the square footage that those departments occupy. So we need to know the square footage, which we do here, 4,000 square feet in total, and then the percent that represents of the total, always 100%. And then I can allocate this $800 to jewelry, repair, and clothes. Pretty straightforward. Now, let's prepare departmental income statements and contribution reports. Here, we're going to have departmental income statements based on departmental sales minus their expenses, minus their allocated indirect expenses, minus their allocated service department expenses. All right. So this service department is a cost center, whereas the operating departments are profit centers. And that those operating departments consist of the hiking department and the camping department. And the service department is going to support that with purchasing. So the department's direct expenses and allocated indirect expenses equals the total service department expenses. And then we're going to allocate a piece of that into these operating departments. Let's see how we do that. All right, here is that information. And our operating departments, good to keep this straight now, these are the operating departments, and here is purchasing the service department. So hiking and camping are going to have sales, and they're going to have cost of goods sold, respectively. And they're going to have direct expenses for salaries and depreciation, but also so is purchasing going to have salaries and depreciation expense. And we're going to have some other indirect expenses called rent and advertising. So our total expenses are going to be $208,000. Okay, so how do we concoct our numbers here? First, we have the rent. It's going to be allocated based on square footage. So notice we're allocating some of it to purchasing here too. So the rent, indirect expenses, let's go back to here. Here's our rent and advertising. So that rent of $12,000, we're going to allocate that to our three departments based on square footage of $12,000. And advertising, we're going to do the same thing, but we're going to allocate it based on sales. Hiking's sales and camping sales. Hiking represented 60%, camping 40%, so that's how we break out that $4,000 and allocate it that way. Now, you can see that these indirect expenses have now been allocated to the three: purchasing, hiking, and camping. And we have total departmental expenses here. Now, the next step in this, now those were indirect expenses. The next piece is we have to allocate the purchasing department, $19,400 here. We're going to allocate that to the hiking and camping departments. And it's going to be based on the number of purchase orders. So we have 840 purchase orders for hiking and camping, total of 1,200. 70% then of that 19,400 goes to hiking, and this 5820 comes down here to camping. See how that works? And so we now have allocated that $60,000 to the respective operating departments, hiking and camping, here and here. Okay. Now, if we produce an income statement, we can do it from those numbers. We have our sales, we have our cost of goods sold, we have our gross profits, we have our expenses, and down here we have the allocated portion of rent and advertising, and then the share of purchasing's expense. And that all totals $24,000. And in this case, camping lost $5,000, whereas in hiking made $24,000. So combined, the company made $19,000 in departmental income statements. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at the departmental contribution to overhead. Until that time, bye for now.